on the currency market right now and see where the majors are trading. Dollar yen, very interesting here. We see that heading back up towards the 100 yen mark. Earlier today, it briefly went past 100 but fell back down again. You got euro dollar at 134.57 off the session highs, but getting some support from the ECB's decision to only cut by 25 basis points. And of course, we've got the non-farm payrolls for the month of March coming out later today. Let's get to our Forex panel for you. Sam Stanley is dealing director at Halo Financial, and Dariusz Kowalczyk joins us as well. He's chief investment strategist at SJS Markets. Derek, let me start with you first of all and throw this question out about the Japanese yen. Why haven't we been able to see dollar yen holding above 100?
I think that the markets are still concerned about the sustainability of the equity market rally. And the yen has basically, over the past few days, regained its role as a potential safe haven. We breached briefly 100 after stock indices jumped yesterday, but as long as there is concern and potential correction in the equity markets, the yen will have to strengthen and go below 100. So all depends on what's going to happen with equities and risk appetite. My bet is that in the near term, several weeks, we will see a rebound in risk aversion, and this would push dollar yen down to levels close to 96.
Sam, what do you think? You know, since the beginning of this week, the yen has been steadily weakening, but we just can't seem to see the yen go past 100.
Yeah, I agree with Darius. In many ways, it is a risk aversion story at the moment. Also, you've got to remember Japanese exporters who have been waiting 5 months to see 100 big figure. They saw it yesterday and they were all over it like a rash. So I think at this stage, 100 is significant resistance, and we'd expect it probably to come off that level back down towards 98 and, as Darius says, around 95, 96 region.
Sam, what happens today if this jobs report is extremely weak, weaker than expected in terms of today's trade?
I think we'd expect to see a sell-off certainly on the stock markets. The Dow had a go over 8,000 over the last couple of days. We'd expect to see that back towards 7,500. I think there'd be a big carry trade unwind. So weakening off in the Kiwi and the Aussie, and probably strength towards the US dollars in the short term, Brian.
You know, we hear so much, Darius, about dollar weakness, inflation. A lot of talk about dollar weakness yesterday, you know, and then you sit down and you look at the numbers and you ask when. What's your insight in terms of when we're going to see pronounced weakness in the dollar because of all the borrowing?
I think that this is unlikely to happen in the short term and even in the medium term. In the next few weeks, if indeed risk aversion recovers, then dollar will also share in benefits of its safe haven status. So it should appreciate against most other majors except the yen. A little bit later on, Q2, maybe the summer, we are going to see the beginning of the recovery of the U.S. economy. I think the U.S. GDP will start expanding in Q3 ahead of the rest of the world. And this, again, is going to be favorable for the greenback because growth rate differentials will move to its advantage. Only later on, when the rest of the world recovers, people will come back to those fundamentals related to the fiscal deficit and the rebounding U.S. current account deficit, which the rebound is going to happen probably Q3, Q4. And then the dollar is going to start to weaken. So I would look for the greenback's depreciation in the second half of this year as well as 2010.
Sam, if I can just come to you on the euro. We had a guest on one of our shows earlier on describing how she believed that the weakest fundamentals come from the eurozone economies at this stage, and there could be a big move to come there. Would you support that view?
I would. I mean, I was very surprised they didn't cut by 50 basis points yesterday, Rebecca. I thought that was a no-brainer, really. They had to do it. Reason being is the data has been so poor. It's really been deteriorating recently. Unemployment's up above 8%. And you've got economies like Spain at 15% unemployment. They really have got some struggling economies, not to mention Eastern Europe outside of the 16 nations. So I think complacency is what we think the ECB is playing at the moment, and really the problems over there are quite pronounced, and therefore I think the euro is vulnerable.
Darius, what's your view? Is ECB showing complacency, or are they just being more cautious than maybe some of the other central banks?
Well, definitely they are behind the curve, as they have historically been, but also they knew that they are unable to reach the consensus yet regarding unconventional measures, and therefore they wanted to keep a little bit of the conventional ammunition in store. Hence, they didn't cut by 50 basis points. As far as the euro goes, initially it got support from that decision because it delayed the debasement of the currency that would take place if they started outright purchases of corporate or government debt. But in the longer run, this only delays the inevitable and also undermines the already very weak fundamentals of the Eurozone economy. Therefore, the bounce that euro got was only temporary, and I expect it to weaken in the near term towards 125 against the US dollar.
Sam, did you believe or buy into any of that anti-protectionist rhetoric with the G20? And to that end, if we spiral down to some nastiness, what will be the currency consequences?
Sorry, Brian, can you just repeat the first part of it? I got the anti-protectionism. What was the first part of it? Sorry?
Yeah, no, I mean, I was wondering if you bought into, all the rhetoric of anti-protectionism at the G20, whether you actually believe what was said as opposed to what might happen.
Sure.
And if we spiral into some nastiness, what's the impact on the currency market?
Well, I think with regards to whether I believed it, I mean, I'd like to believe it. I think all of the central bankers there and all the finance ministers there actually understand that protectionism does not work. However, they can say one thing and do another, and that's what tends to happen at these G20 meetings. There is a lot of protectionism, that has been put on the board recently under the spotlight and under the radars. And I'd like to think that we're not going to see any more of that happening. So I'll give them the benefit of the doubt, Brian, that they do believe that it's not going to help this economy out of the woods. With regards to the effect on the different economies, well, certainly you've got to look to the exporting nations who relies most heavily on trade, and therefore who is going to be the most affected by this. And certainly countries like China, if the US put up trade barriers, that is going to affect their economy. They're the buyer of last resort. It will also affect other economies in Southeast Asia, not to mention the smaller nations around New Zealand and Australia, for example, who do rely very, very heavily on exports of commodities.
Protectionism, it's a word I struggle with too, along with toxic assets. I have to say it very slowly.
Absolutely.
Sam, have a great weekend.
And
Sam Stanley, Dealing Director at Halo Financial, as well as Dariusz Kowalczyk, Chief Investment Strategist at SJS Markets. We appreciate the insight on this Friday. Let's stick with